Here's the S&P 500 MMT. It's live on a Saturday training session, as always. When we had made this first great 2012 bull run, and here's where 2012 started, and the shorts got taken all the way out, and it just kept going higher and higher and higher. So everything that happened back here in calendar 2011, all they did was buy all the short interest back. We got to the top. 85% of the bulls were never involved. No, they weren't. Then the earnings season that we're in right now, that's starting to wind down, we had the big correction that I said that the S&P had to have its bull rally correction, and as it has. Now, why are we going to be a second time? Why do we believe that part of the summer now, not all of the summer, but part of the summer has to have another shakeout? And why is it that the price volatility that we said would happen April 4th, or the first trading day of April, would increase as it did? And here's a double top, blow off top reversal in the S&P. And here comes Apple, and here comes the earnings season. So this was your phase one correction. And there are 4 phases to a bull top or bull rallies that start in their topping processes. So every bull trend has a counter trend. And every bear reversal has another new bull trend that come in and they buy up the dips. That meant that what drove this higher is the catalyst to keep it going higher is going to be very, very, very difficult to get much higher during this cycle. Even if we come up and we hit what we call this, we would call it a triple top. One of the things that I'm going to go involved in is I'm only going to pull up this piece of the chart, and I'm just using the daily. And what I'm going to say is I'm going to draw another trend line right about here. And one of the things that we look at in key reversals is the following. This is the wall of resistance that I said that we would test. This was that initial bottom, straight down. This was the area that held that resistance. This is what we call the double bottom. We're above it, but you got to remember, most of this is contributed to what? Apple Computer. And that you've had 4 up days of last week. But you can see 1 day, 2 day, 3, 4, 5 days down. And you actually even went into a daily sell signal on this daily chart because you did. And you worked that overbought process off of 92.58% on a daily because you did. And this is all about how do I trade the trend. We got down here to 23%. That's how you work that bull off. Now we're back up here on a daily as 71%, not nearly as high as we were here. This is going to be the wall of resistance. As we come up and start testing 1410, the 1420 level where we were short the S&P, go to stockmarketfunding.com and you can see why we told you had to go down. Every bull has to come down, and every bear has to get reversals and go back up to these resistance levels. Now moving forward, as I've said, we are going to be taking a look at the May contracts on the S&P 500, the regulars. And what we're going to be doing is we're going to be looking at the adjustments in some of these puts. And here, when we talk about call and put ratio, the puts are, yes, the puts were inflated up here. They had a great move and they got back up to $65 a contract. They're on sale. Sorry to tell you. And let me tell you what, they can get more on sale, but they're on the deflated side of the market. Yes, you're at 1403. Yes, you're 17 handles away. If we go up to test the double tops or triple tops or a lower high reversal, that means that these contracts can trade down to $18.50. When you buy 50 of them, though, and you make a $40 run, it's a $200,000 profit. Ka-ching, a ring-a-ding, that cash register. Now, not everyone's qualified to trade index options. It takes a lot of training. However, these are deflated. Now, if I go back over here and take a look at the call side of where that burn rate started running, and I'll just keep this very simple for my MMTs, is that at the 1360 call right here, that call was so freaking inflated up here, and I'll give you the exact date. We'll give you the date. Here, let me open up the date stamp. When these calls were up here on 4/2, they were high as $70 on 4/2. That's this month. Buddy, that's what, 26 days ago? Yeah. And they were inflated. They had to come down. We're experts at mathematical calculations in inflated versus where they got deflated. They were on sale at $23. And they've come back up here. So as we go back up here, what we'll be looking at doing based on the S&P trend, that's going to be the lower end of the bottom of these 3 days when these calls were, and believe me, you'll never see a call contract ever stay up here. It's humanly impossible. It's mathematically impossible. Having said that, we've gone from here to here on the call side. It's a 1360 call in the money where that rally started in the S&P for 4 days. 1 day, 2 days, 3 days, 4 days. That's all last week because they were down here. They were no longer, all the risk was in the world for the bull was up here. Now that they corrected, they're coming back up, and we'll be looking at where that an individual can short a contract if they are permissioned. You can sell puts and you can buy calls, but let's get back over here. I just want you to see the differences between, this is a deflated 1420 put right here versus that short term. So you had, you drop from, let's say, $60 down here to $27, and you can come down around $18.50 to $21, and you'll hit a bottom as the S&P 500 index is at the wall of resistance. It's going to take a lot of catalyst. It's going to take a lot of news. Most of the earnings season's out of the way. We got the unemployment number coming up this Friday with the ISM, the PMI, Purchasing Manager Index. We got lots of things that are happening in Spain. Just remember that every bull rally has a reversal in a 52-week calendar period. That's your 52-week high. And in the shorter period of time, with Ben Bernanke and Geithner and all the stimuluses, they're in play, but they're going to wear off because I'll tell you why. If there isn't any QE3, if there's no QE3, you can end right back up here at the end of the calendar year. And we'll tell you up front. We're going to tell you up front that if the market doesn't get a welfare rebate program from the Federal Reserve, you can end up right back where you started the whole year. And that means that there's going to be more corrections and more higher price volatility in the S&P 500. It's going to take a lot of news to keep this thing going to break these highs. So we're going to be doing the put strategy because the put side is the most cheapest side of the market right now. And as these things get on sale throughout the month of May, you can see on the volume side, they were buying the 1400s on Friday. Boy, were they buying them. 6,000 contracts. They bought 9,000 here. There's 55,000 open interest right here. And boy, at 1375, they were getting gangbusters on it, and they walked them against them. But you can take a look at some of the open interest in here. Back over here at the 1350 where we found support on the S&P right above that 1340 handle where I talked about, you got open interest at 78,000 contracts open with 9,200 traded on Friday. And another 9,200, like I say, at the 1375. And they're moving in heavy at the 1390 right below it. And guess what? They're on sale, meaning that when we take a trade, we take it because of the mathematical equations, not what our mind says, not what our belief may or may not be. No. The math will never lie, nor will be deceptive. But your opinions and your media and all that other stuff, well, hey, and mechanical stuff and markets and exchanges, that's a whole different thing. I will tell you, though, that the math will not lie, and SMF has not been wrong yet on every major pullback and or every major correction. Not one. And we've called them all, and we got them all live to prove it. If you want to get on this bandwagon, I suggest you come and learn and be part of one of the most wonderful groups there is in the world, and that's right here, right now, on a Saturday, looking at how to make some serious coin. And not only that, once we come up and test these areas of resistances, I get to take this S&P short just like I did over here. Of course, I had to get out of it because that was the end of it in this phase. We came down, we hit that 1350. 1343 was a key area. This is that double bottom 1360. You can see right here based on the S&P that you don't buy puts down here at the bottom in a bull run. You buy them up here at the top where the reversal is. That's why that open interest is as heavy as it is, and they're all underwater. And SMF, MMTs are going to move in, and they are going to get the lowest dollar capital risk exposure to that next reversal. And we shall be right. Because I will tell you that right now, that part of the summer is another correction. This is correction one. There will be a secondary one, and it's coming soon. Because there's going to, what kind of headlines are going to be left to drive it? Well, there's no more earnings that are going to drive it. Not in the S&P 500. Most of them are reported. Some of the scorecard was good. It's a stock by stock basis. But the broader 500 stocks in there on my reporting method is not what you want to be, meaning that with the stimuluses and whatnot, people have done fairly decent in the reporting session. However, it's not good enough. Not at this valuation. So that means that in bull rallies in this year, we're going to put in another top on the S&P and have another major reversal. When I go out here, I want to show you something that will interest you. I'm going to show you out here in the month of July at that 1350 put. They were buying 6,900 contracts over here on the volume side, on the day volume. If I scroll this right back over here, I don't see but 510 volume here. I see a lot of volume in July starting to pick up. And I can see where the open interest is compounding here because people are putting on some big hedges. And the reason why they're putting on hedges is because volatility, complacency, and fear factor still remain at very historic lows. I'm going to go out here and I'm going to show you that in the month of December at a $1,300 put, there was 4,500 traded. There's 79,000 open interest at that 1350 December put. Okay? And I can tell you that the call side, on the other hand, on the day volume, on the open interest volume, you still got a lot of people that believe at the end of the year you're going to be at 1,500 or higher. There's 105,000 of them open. They were buying them up and out of the money here. They were buying these up and out of the money. This is a December $1,400 call. 77,000 open interest. How about this one? Listen to this one. People believe that you're going to be at 1,600. Look at here, 152,000 contracts open. I'm sorry. I'm taking the other side of that money. I'm getting paid off of that because they're wrong. You will not be above 1,600. All of this here, 61,000 contracts open interest at the 2,000 strike on the S&P for December. That's ridiculous. I'm just giving you something to look at, MMTs, so that you can start getting in tune with some of these longer term looking trades and where these open interests are. But we'll deal with, what we deal with is that regular, and you can see here, even in the month of June, you've got 114,000 open with 11,000 contracts traded Friday. Yeah, how about this one, the 1370 put? You had 30,000 traded on that June 1370 put. You had 26,000 traded volume Friday, all volume Friday. 1390, they're moving in big. That's huge volume for the put side in a bull run. And that's the June. And you had a lot of it. The May regular, of course, you didn't have that kind of volume. They're going out to that June period, and some are going into the May. That's still good volume. Still pretty decent volume for the calendar month of May that we're going to start on Monday, this next trading week. And the jobs reports are coming out. But my point of it is, MMT, no one's going to be wholesale to the market except you. You're going to be the cheapest to the market based on the fact that you know when to come out on index puts and then get long calls, and you know when to come out. But you also know that Mario says that you're going to have another reversal trend, and it's a time series, and there's very little left to drive this catalyst higher. And that GDP that they thought they were going to get 3% out of, it's lower than the last quarterly GDP report. Came in about 2%. Sorry, big disconnect. But nobody ever said that a bear has a right mindset or a bull has a right mindset. The only person I know that has a right mindset is an MMT full-fledged market maker trainee who is learning how to work these markets in a totally different fashion than they've ever worked them in their entire life. And once again, the path to prosperity, or the path to prosperity, is understanding that as we come up here on the 5th day, because you had 5 days, 1 day, 2 day, 3 day, 4 day, 5 day. Oh, 1 day, 2 day, 3 day, 4 day, and we're going to hit the 5 day to the upside. And once as we hit that next 5th day up, that's when we're looking at moving in at the most discounted wholesale price to what? A risk management. Dollar cost risk management. I am putting out another trend that when we hit that resistance, we're going to have that the second reversal will be deeper than the first bull reversal. This reversal. The second one will be greater than the first. In count number 2 reversal of the overall bull trend. So if you've been holding on to stuff, you better think about how to lighten up, because that next reversal is right around the corner as we come up and you hit this wall of resistances and or make a triple top up here. Yes, I said triple top. I said triple top. That's the double top. That makes a little blow off high, and then you start down. And that's going to happen here. Lower, high. This is a hot. We could come right in here. Slightly above the 1410. And it'll be a case-by-case basis. There will be another bigger reversal before the July period gets here. So that once again, that once you have that next deep reversal and shakeout number 2, that it will be buyable for the long side again, because everything is buyable in both directions. Let it be known now that the S&P puts are cheap. They're on sale. We'll be making that trade in that next reversal like we did the first reversal. And I'm going to throw the Dow Jones in here just very quickly. I'm going to throw the Dow Jones in here very quickly. You can see the Dow has already come up, and it had a nice correction. Now, let's take a look at the double top on the Dow. Right there. It's coming right up there. Look at the correction that we had called for. Look at the bottom. We got that bottom. Apple Computer had a lot to do with it. There were other companies that had. There were some good companies that reported in the session, as should. However, this next top, if we come up here, we'll be looking at the diamonds and other various bear ETFs that could be traded, because that wall of resistance is upon us within this bull reversal. And this is the 4th day up. You had 1, 2, 3, 4, 5 down. Then you came up and you consolidated, but you've had a 4-day breakout. So this is how trends work overall. S&P 500, Dow Jones, topping resistance patterns. There's such a thing as a blow-off top, but the reversal is around the corner, and I've concluded that for the MMT. And you'll be able to take a look at lots of various different things that you can trade. And we'll go through those, not right now, but we will go through various different things that you can buy. Here's the diamonds right here, Dow Jones. And you have to have a lot of contracts to make money on these things. But when you know where these things are, um, these are buyable and tradable for profits, both bull and bear side of the diamonds and whatnot. And there are good bear ETFs that are 3x bear Dow ETFs that will pay money as well. So I'm going to conclude S&P 500 and Dow Jones. And once again, I'll leave you with the note on the S&P 500. It too is going to run up and test its tops. And then the next reversals around the